Hey, what's going on everyone? It's Griffin here, and in today's video, we'll be speaking about all of the Canadian investment accounts available right now, both registered and non-registered, covering what they're about, how you can use them to your advantage, and what changes are new to them as of 2024. Let's get into it because there's a lot to cover. All right, so starting off with the most popular Canadian registered investment account, we have the tax-free savings account, TFSA for short, which provides Canadians with a way to grow their wealth without the burden of taxation along the way. So this account was introduced in 2009. The TFSA has since become a key player in helping individuals achieve their financial goals through tax-free investment opportunities. Now, at its core, the TFSA is a registered investment account that allows Canadians to contribute a set amount of money annually. In 2024, that amount is $7,000, with the earnings generated within the TFSA over time being shielded from any form of taxation, where the appeal lies not only in the tax benefits, but also in the flexibility that this account offers in terms of what types of investments can be held within it. So contributions to a TFSA are made with after-tax dollars, meaning there is no immediate tax deduction on your tax return in the given year. However, any funds taken out of the TFSA, whether it be the original contributions or the gains themselves, are entirely tax-free, which makes the TFSA an attractive option for both short-term and long-term financial goals. Now, one of the distinctive features of the TFSA is the cumulative contribution room, where if an individual does not utilize their maximum contribution in any given year, well, the unused room carries forward to the next year and so on. So this accumulation allows for more significant contributions in future years, offering flexibility in how one chooses to use the account. Additionally, the investment options within a TFSA are quite diverse, as mentioned earlier, ranging from simple savings accounts and GICs to stocks, bonds, mutual funds, and exchange-traded funds, all of which allow individuals to tailor their investment strategy based on their risk tolerance, time horizon, and financial objectives, where the TFSA complements other retirement savings vehicles as well, like the Registered Retirement Savings Plan, RRSP for short, which we'll be speaking about next. But in essence, whether you're saving for a home, education, or retirement, the TFSA is a great account for Canadians to grow their money tax-free, and is therefore one of the first accounts that I tend to recommend most investors open up when first starting to invest. And by the way, if you want to learn more about the TFSA and how much you can contribute to your own TFSA, I've made a full dedicated video for the 2024 season covering multiple scenarios and examples that you can check out right here. The Registered Retirement Savings Plan, RRSP for short, is another cornerstone of investing and financial planning for Canadians, offering a strategic and tax-efficient approach to building a secure retirement. So this account was introduced way back in 1957, but it still remains a powerful tool to this day that enables individuals to save for their golden years while enjoying valuable tax advantages along the way. So at its core, the RRSP is a tax-advantaged investment account designed to encourage Canadians to save towards retirement, where one of its primary features is the tax deduction provided on contributions made to the account. So when an individual contributes to their RRSP, they can deduct that amount from their taxable income in that given year, effectively reducing the amount of income tax payable for the year. And this immediate tax benefit makes the RRSP an attractive option for those looking to minimize their tax liability while actively saving for retirement. Here's an example. If you have $60,000 in taxable income for this year, but choose to make a $10,000 RRSP contribution, if you're able to, well, you'll only be taxed on $50,000 rather than the $60,000, which can be quite the difference, especially if that contribution brings your taxable income into a lower tax bracket. Now, similar to the RRSP, contributions to an RRSP can be invested in a wide range of assets, including stocks, bonds, mutual funds, and exchange-traded funds, with this flexibility allowing individuals to once again tailor their own investment strategy based on risk tolerance, time horizon, and financial goals. That said, the growth generated within the RRSP is tax sheltered along the way, meaning individuals are not going to be taxed on any capital gains, interest, or dividend earned within the account, but deductions down the line during retirement are added to your taxable income in that given year, which is why the RRSP also plays a crucial role in retirement income planning, whereas individuals nearing retirement age can begin to withdraw funds from their RRSP to support lifestyle. However, these withdrawals are considered taxable income, and taxes are incurred at the individual's marginal tax rate at the time of withdrawal, hopefully in a period though of your life where active income is quite a bit lower. Now, to further enhance its utility though, the RRSP also provides a unique opportunity for first-time homebuyers, where under the homebuyers plan, HBP for short, individuals can withdraw up to a specified amount from their RRSP to fund the purchase of a first home, with the condition that the funds are repaid to the RRSP over a 15-year period. So definitely a good deal. And this is a huge advantage if you currently hold RRSPs and are looking to, in fact, purchase a home in the near future. And this actually brings us to the next registered account that's new and specifically tailored for first-time homebuyers. That being said, unlike with the TFSA, where every single year all Canadians above the age of 18 are given a specific amount that they can contribute to that account, the RRSP is calculated differently in terms of contributions allowed, and it's going to differ from individual to individual. It is typically going to be 18% of the previous tax year's total declared income. So here's an example on screen, and you can calculate this for yourself. The tax-free home savings account, or FHSA for short, is a completely new investment account that is designed to help Canadians save for their first home. And it was just introduced by the Canadian federal government in 2023 as a part of its effort to make home ownership hopefully more affordable, or at the very least attainable for Canadians. What's new about the tax-free first home savings account is that it enables eligible Canadians aged 18 and up to save up to $40,000 in the account for the purchase of their first home. And in this light, you can contribute only $8,000 though per calendar year to the account, meaning 5 years of contributions at the maximum $8,000 would give you $40,000 in contributions. But you must also use these funds within 15 years of opening an FHSA or before you turn 71 years old, whichever ends up coming first. Otherwise, the account will be closed and those funds will be returned to you at a taxable rate. Now, in regards to what makes this account different and even relevant as this new sort of offspring between the TFSA and the RRSP, is that this account combines the best parts of the RRSP, which gives you the tax deduction perks on your taxable income, as well as the TFSA though, which lets your investment grow completely tax-free over time. So this means that the money that you end up putting into this new account and earn in this account goes entirely towards the down payment on your first home. Now, the RRSP currently also offers what's known as the home buyers plan, like spoken about earlier, that allows you to withdraw up to $35,000 from your RRSP tax-free towards buying a new home, which will tie into the FHSA here, in that if you've been contributing to your RRSP for years, let's say, and you are already planning on utilizing the home buyer's plan to purchase a home to begin with, well, the CRA has confirmed that a prospective buyer will also be able to withdraw from their FHSA, the new account, but then also utilize the RRSP with the home buyer's plan, utilizing both in combination. So if you're in the market for a new home at some point over the next 15 years, the FHSA will allow you to take advantage of the tax benefits of contribution deductibility in the years that you make the contributions, like the RRSP, while also growing your funds tax-free like the TFSA, making the trifecta of RRSP, TFSA, and FHSA a really good arsenal of registered investment accounts to achieve your financial goals. deals. Hey, quick break here to mention a stock market investment platform called Moomoo that's been extremely popular over the past couple of years in the United States and abroad, but is only recently just launched in Canada, which I'm very happy about as I've been waiting on this moment for years. So I wanted to mention it in today's video as it truly has an insane amount of free functionality built right into the platform for stock research. As we can see here in the markets tab, Moomoo offers investors the ability to invest in equities and funds from North America, Asia, and Europe, making it an extremely versatile all-in-one stock market investment platform that also offers data and functionality for crypto, forex, futures, and bonds. They currently only offer cash accounts in Canada, but are rolling out the TFSA and RRSP over the next couple of weeks, so make sure to sign up to start taking advantage of their research functionality today. And by the way, they're running insane sign-up bonuses right now, reaching up to $1,500 in cash coupons for your deposits, with a minimum bonus of $20 for any deposit. So even if you open an account and deposit $1, you'll get $20 for free. Again, check out Moomoo down below in this video's description. All right, getting back to the video and moving into the next registered investment account, the RESP. This one differs slightly from the rest in regards to its purpose, but remains a very useful account for Canadian financial planning, specifically tailored for families aiming to accumulate funds for their children's post-secondary education. So central to the RESP's appeal is its tax advantages with tax-deferred investment growth as well, due to contributions being made with after-tax dollars, just like the TFSA, for example, and the investment income generated remains untaxed until withdrawal down the line by the student beneficiary for educational purposes. What differentiates this account from others, though, are the matching government contributions to the account, which further boosts the speed at which this account can grow. In fact, the Canadian Education Savings Grant, CESG for short, matches a percentage of annual contributions up to $500 per year to a maximum lifetime amount of $7,200. And then the Canada Learning Bond, CLB for short, provides additional support for lower income families, kickstarting the child's educational savings journey. Regardless though, all Canadians can take advantage of government contribution matching, which makes the RESP attractive for saving towards your child's education. Now, similar to the other investment accounts covered, the RESP allows users to buy and hold mutual funds, stocks, bonds, GICs, and ETFs. And if down the line, one of your children who was the beneficiary of the RESP in question chooses not to pursue post-secondary education, that's totally fine, as the plan permits a seamless transfer to another eligible family member should circumstances change. And while there's no annual contribution cap, a lifetime limit of $50,000 per beneficiary is enforced. So keep that in mind to avoid over contributing penalties, and also consider that to receive the CESG matched contributions must be made to the RESP in the first place, but the CESG adds an amount to the RESP based on annual contributions made, where if eligible, beneficiaries can receive up to 20% of the first $2,500 contributed to the RESP annually. So it makes more sense to contribute smaller amounts yearly to get those $500 government matches. And finally, of course, we have the most basic and bare bones type of investment account available in Canada, the cash account, quite simply, which isn't to be confused with, say, a regular cash bank account. We're speaking here about a non-registered investment account that would be used when and if other registered investment accounts end up getting maxed out, but you still wish to continue contributing to your investment portfolio. So a cash account essentially has no tax sheltering benefits to it. So unlike with the TFSA, RRSP, and so forth, you're contributing after-tax dollars and will be paying capital gains tax on dispositions, as well as tax on any dividends that you receive and interest income earned within that account. So if you're new to investing, starting with one of the registered investment accounts that we covered in this video will most definitely be the best bet to keep more money in your pocket. And once you're familiar and more comfortable with investing something though, and your registered accounts are fully maxed out, well then considering opening up a cash account will be the next step. I really hope you enjoyed today's video. If you did, please take a second to drop a like, subscribe to the channel for more investing content, and don't forget to comment if you have any questions. I'll make sure to answer as many as I can. And also I'd recommend that you check out the links down below in this video's description to, for example, my full 7.5 hour stock market investing course over on Skillshare. Has over 1,500 students and great ratings. It is completely free for you to watch. Also, don't forget to sign up to Moomoo for those amazing cash bonuses right now when you open up and fund your account. So thanks for watching, and I'll see you in the next one.